Good day, everyone, and thank you for joining the BNY Mellon Wealth Management Webcast series. On behalf of all of us at BNY Mellon Wealth Management and today's co-host at Flagship Healthcare Properties, we hope that you and your families are continuing to stay safe and are learning to manage the challenging environment we all find ourselves in today. Today's webcast is a very timely market and economic outlook featuring my esteemed colleague, Jeff Mortimer. My name is Scott Barron. I'm a client strategist at BNY Mellon Wealth Management. Joining me today in hosting duties is Brandon Edge, President and Chief Operating Officer of Flagship Healthcare Properties. And Brandon, I just want to say thank you for your partnership in this event today. Before we get started and I turn it over to Brandon, we just wanted to give a few housekeeping items for everyone on the line today. If you have a question, we'll be addressing those in the latter part of our program. Please let us know you would like to ask a question by raising your hand function to the right of your name on the right side of the page. In order to maximize streaming efficiency, please close all open applications on your computer or smartphone while viewing this webcast. A replay of today's program will be made available, and you will receive an email in a few days containing the replay link as well as access to the materials. If you have any additional questions not addressed today, please reach out to my colleague Dan Bowling, who you RSVP'd to for this webinar. And with that, I'll turn it over to Brandon.
Thanks so much, Scott. And it is a pleasure to be with you all today. I was thinking back to the first time that we had the pleasure of hearing Jeff speak, and it was here in Charlotte, where I'm speaking to you from today, back on March the 6th of this year. And as everyone here on the line will hear, Jeff's commentary is incredibly insightful. And so when the BNY team invited us to participate today, we jumped at the opportunity. So thank you very much to the BNY Mellon team, and we're looking forward to hearing your words today, Jeff.
Thank you, Brandon, and we'll go ahead and jump into the presentation. I'm thrilled to introduce my colleague, Jeff Mortimer, who is one of our most sought-after specialists with more than 25 years of experience in the financial services industry. Jeff is the Director of Investment Strategy for BNY Mellon Wealth Management. In this role, he leads a team that sets capital market expectations and is responsible for making asset allocation recommendations for all of our clients' portfolios. Jeff is a national speaker on issues of investment strategy, the financial markets, and the economy. Some of you may have already seen Jeff in the media on outlets such as Barron's, Fortune, Bloomberg, and CNBC. I'd like to extend a very warm welcome to Jeff, who is joining us today from his office in Boston. Jeff will provide his insights on the economy, and Brandon and I will return later in the program to facilitate our question and answer period. Jeff, the floor is yours.
Scott, thank you very much. Good afternoon, everyone. A pleasure to be with you, albeit virtually. This is our new normal, and I look forward to sort of sharing my thoughts with you. Some guidelines about me. I am neither bullish nor bearish innately. So it's not, I am paid to understand economics, markets, and to help clients navigate market cycles. That's why I'm here within wealth management. I chair a committee of 20 of my peers. We average 30 to 35 years experience each. Our chief economist is on that committee. Our head of equities is on that committee. Our head of fixed income, head of alternative investments. I have a wonderful group that I can draw from to ask them for their expertise. We come from different backgrounds, but all trying to solve the same riddle. I'll present to you some charts today that are kind of on our minds, what we think is important to going forward. Certainly, you tell me how COVID-19 goes, and I'll tell you how the recovery goes. It still remains a very important variable, but it's hard for someone in finance to map or model COVID. So we have to sort of watch that go on in the background. Certainly things that we can map or model much more efficiently are market valuations, right? Market internals. We can certainly map and model presidential elections. Markets are very good at those, actually. They get a lot of practice. They have to practice presidential elections every 4 years. And I'll show you data which goes back 100 years and how markets digest different regimes in Washington, to give you some sense of kind of what we can expect from markets going forward. So let me sort of lay down some economic charts at first. It'll be fairly painless, but I just want to show you what our committee is paying attention to as we make decisions in the heat of battle, and what we consider most important. So why don't we go to the first page? And this one really looks at LEI stands for leading economic indicators. So this is a group of economic indicators which attempt to look out 6 months. And we look at these globally. And as you can see, whether it's the US, China, these are large economies throughout the world. There's only one letter to describe what the leading economic indicators are saying, and that is a V-shaped recovery is possible. We'll have to see how this actually plays out. Again, they're trying to predict 6 months ahead, but clearly they have the potential, global economies have the potential to snap back. Now, of course, that doesn't mean that all industry groups are included in these things. It doesn't, right? These are macro levels looking down from 30,000 feet, but certainly the potential does exist for a V-shaped recovery globally, sort of depending on COVID. The potential for a second wave perhaps is beginning, which may put a little bit of doubt into these numbers. But as we sit here today, certainly a glass half full, at least for the time being, is the way the economy seems to be breaking globally. Let's go to the next page. One issue in the U.S. That continues to be a little bit not concerning to me, but is a lagging indicator. So this is always the way things work, but it is non-farm payrolls. This is employment data. So clearly, rough numbers, we lost 22, 23 million jobs. We've gotten about half of them back. The bad news there is that that was the easier half. The other half, to me, I think we're going to get sticky on unemployment around the high sevens, because now it's restaurant, travel and leisure, right? A lot of those jobs, which I think will take quarters or years even to come back. So I think the easy work has been done here. We'll have to see how that manifests itself in our economy. But it is one reason why the market is clamoring for more stimulant, is the right-hand side of this page. Personal consumptions have rebounded fairly assertively, a lot of that helped by fiscal and monetary policy globally. But the market clearly wants another stimulus package to help those workers which continue to struggle under the weight of COVID-19 in their affected industries. So we'll have to see if they get it pre or post-election. Markets sort of throwing a little bit of a temper tantrum over the last couple of days with a little bit more delay in Washington. So we'll have to see how that plays out. But markets, at least for the time being, seem to be given the benefit of the doubt that eventually a package of some size will. Next page, please. Savings rates are interesting. This brings up a lot of issues for me. Certainly during the COVID early days, we do what most humans do when we face uncertainty, and that is we don't spend money, we save it. And our savings rate in this country spiked to around 35% of disposable income. That has since recovered to the high teens, but is quite a bit above 5 to 10% where it is under a sort of normal background. This reminds me really of the 1918 pandemic, potentially. Remember that the 1918 pandemic was followed by the Roaring 20s. And I know that was a celebration of the end of World War I, certainly, but I think it was also a celebration of the end of a pandemic. And pent-up demand and pent-up gatherings and all these things that people wanted to do. And this savings rate now still remaining above normal shows you that there's money, perhaps a dry powder, which remains outside of the economic world as we speak, 4.7 trillion in money funds, for example, that has the potential to be an economic stimulant or even move into markets themselves going forward if and when COVID is eventually brought under control. The right-hand side of this page shows you that the U.S. is not alone in increasing its savings rate. This was a global phenomenon. It shows you that humans are more alike than different. Next page, please. Here is an example of a stimulant. These numbers change daily, of course, as they continue to wrangle in Washington. This is a $1.5 trillion deal, and some of the, I'm not going to go through the bullet points, but you can read them at your leisure, but certainly stimulant checks, a PPP, all these things to certain industries, industry groups are all on the table. So we'll have to see what eventually comes out of Washington, but again, very stimulative in the near term. We can worry about the debt sort of later, and with very low interest rates, that the debt continues to be very manageable in Washington, at least for the time being. I get a lot of questions about debt as a strategist, but I remind people that a stimulant into an economy, at the first part of that is very robust. It is very stimulating to economic growth and can be very positive for markets. So that happens first. the debt repayment and those issues can sometimes happen years, even decades and down the line. So we'll have to monitor these things, of course, over the longer term. But in the near term, of course, a stimulant would be very, very appropriate potentially for the market and for the economic growth. Next page, please. A yield curve steepening. This is a very good sign. This is the Treasury market and signaling the potential for stronger economic growth going forward. So I've showed you the leading economic indicators of the economy. I've shown you sort of the increased savings rate. You see a lot of dry powder happening economically. Now let's get into what the markets are talking about. Here's the Treasury market, one of the largest markets in the world. And what does it signal? As this curve steepens, the 210s steepen, it's shorthand for the higher this line is on the page, the more that the bond market, high quality bond market, is anticipating stronger economic growth going forward. So the higher this line gets on the page, you can see what's happening recently, is the better it is for economic growth going forward. Again, these are people who are demanding interest rates at certain levels. And again, what I've seen in the near term shows me that the bond market may be finally buying into the fact that a stronger economy as you get out 3, 6, 9 months might be what it is betting on as rates have moved higher, differential in rates between a 10-year yield and a 2-year yield. Let's go to the next page and look at corporate bonds. This is showing the same picture. Corporate bonds and the yield demanded for lending money to lower quality companies is in blue and higher quality companies is in gold. And when the economy is struggling, you demand a lot more interest rate, higher rate to lend money to a low quality company when the economy is not doing well. You expect the economy to do well in the future, in the near future, then your rate demanded, even to a low quality company, goes down because a stronger economy lifts all boats, and even a weaker company with a weaker balance sheet and more debt should be able to service that in an economy which is doing well. And what you see here is the mountain, which clearly took place during COVID, and look at how it dissipated. We're now down to 479 basis points over treasuries, lending money to low quality companies, almost to the levels that it was pre-COVID. We're not quite down to those levels yet, but we're pretty close. And that's a very good sign to me that remember bond lenders, they only have no upside, right? It's not a stock which has unlimited upside. The only thing that happens to a bond manager is they lend money. Then they hope like hell that they get their interest payments. And then, God willing, they get their principal payment at the end. And so there's only downside for them. And so the fact that they have come back to levels of demand of interest rate that is almost pre-COVID is very impressive. And again, they're signaling as well that a stronger economy may exist on the other side. The gold line, very similar. They're lower interest rates because these are higher quality companies and corporations, not quite to pre-COVID levels, but also pretty close. Next page, please. The stock market, what is it signaling? Well, this is from the low of March 23rd, which was the COVID low of the stock market. We've rallied significantly since then. Large cap and small cap on the left-hand side of the page, dead heat. But the market clearly on the right-hand side of the page is beginning to disconnect between growth and value. And I really look at this recovery as more of a K-shape. I think the market is attempting to separate companies which will not only survive COVID, but will thrive on the other side. And it's willing and able to pay up for those types of firms. I look at COVID not really as a game changer, but more as an accelerant. A lot of these issues were already in play. We were over-mauled in this country, right? We had begun to telecommute. We had begun telemedicine. We had begun a lot of these issues where COVID-19 brought all of them to the forefront. It's almost as if we're having this meeting and it's 2023. It's another way to think about that. A lot of these companies have had revenue pulled forward. And if you pull all that revenue forward, the current stock price didn't reflect that pre-COVID. And now when you get to a post-COVID world and full adoption, you see how these stock prices go up well in advance because that cash flow has been brought forward, revenues have been brought forward, earnings have been brought forward. Value companies, not so much. Energy, financial companies struggle in a flat interest rate environment, for example. So the haves and the have-nots of this are really shown to me on the right-hand side of this page. But that being said, stock market also signaling, just from its incredible strong performance over the recent 6 months or so, also signals that a stronger economy may in fact lie ahead. So now you have treasuries, corporate bonds, and the stock market all sending signals that better times may lie ahead. Let's go to the next page. Market is broadening. As bull markets age, you'd like them to broaden out and include more of their membership. And that is, in fact, what is transpiring. This is by a sector, and this is looking at how many stocks are in an uptrend. And you can see that technology certainly has carried a lot of water. 75% of those stocks are in uptrends, but that's not as good as industrials, staples, healthcare, materials. You notice as you get down to value sectors, those are energy and financials, you get sort of the bottom of the barrel. And you see here again that while they are still minority in uptrends, you can see here again growth versus value. But the market is beginning to be much more inclusive, which is a very healthy thing for a market to do and a typical thing for a market to do as bull markets age. So it's very good for me to see that is in fact happening. You do not want to see a market led by 5 stocks, to infinity. Those tend to break down. That in fact it is broadening out is a very good sign. Next page. Let's talk about seasonals, the election, because it's on everybody's mind. This is just the seasonal patterns within the stock market. You can see as you get late in the calendar year, whether it's an election year or not, you tend to go up in the fourth quarter. Many markets bottom in September or October, and you have a very strong November and December. Whether it's an election year, which is in blue, or a non-election year, all of history is in orange. But regardless, understand the trend in markets in Q4 is to rise. Next page, please. I'm not here to discuss politics. I will discuss policy and polling data, and we'll get into some betting. We'll get into the betting odds as well. This is a comparison of Biden to Clinton. And it shows Biden's lead over where Clinton was 4 years ago. And Clinton, we can see what happened to her as election day approached. She sort of went into the waterfall as Trump really began to really make up a lot of ground as we approached election day back in 2016. Biden even has more padding. He has a lead. His ratings, his unfavorable ratings are not as high as hers are. And while it's possible that he may suffer the same fate as Clinton as we get closer to election, but please be cognizant that he has a lead over even where Clinton was. And even in swing states, which is the lower panel, he leads Clinton as well. Why do I show these pages? Am I rooting for one over the other? Am I predicting one over the other? No, on both counts. I'm here to show you what the markets are paying attention to. And when I see data like this, and when I show it to all of us, please understand that markets also are looking at this data. And markets are very good at discounting the most likely outcome of an election. As I mentioned at the top, markets have had a lot of practice at discounting most likely outcome of elections. They're occasionally surprised, but it's very rare. And a lot of this polling data has improved from 2016. Polling data, they did not like that they got that quote unquote wrong. And so a lot of them have improved their maps and models to become even more accurate than it was back in 2016. So if we're looking at this data and seeing Biden so far ahead, then I believe the market is also discounting a Biden victory, even as we sit here today. In other words, if Biden is elected president November 3rd or shortly thereafter, that the market move, I believe, will be very minimal because it's already baked in that Biden will win. So whether you like that or not, irrelevant. Right? But the people that say to me, if Biden is president, I'm going to sell all of my stocks. I show them data like this saying, well, the market's already said Biden will win, right? So if you're going to sell your stocks, then you may as well sell them now, right? But people say, well, the market's up, it's doing well. Understand that the market is digesting information in a real-time basis and always discounting the most likely outcome. Let's go to the next page. We'll look at betting odds. This clearly shows, while it's illegal to bet on presidential outcomes in this country, it isn't worldwide. And Biden knows a 2/3, 1/3 lead over Trump, even in betting lines. These are people that are putting their money down, money where mouth is. And again, 2/3, 1/3. Markets look at these things all day long. And again, more proof that I think markets are discounting a Biden victory, or a very high probability of that happening. Next page, please. This is perspective. I really like to show this data because it shows various returns on the S&P 500 going back nearly 100 years when all the different regimes are in Washington, whether you have a Republican president and how the Congress is broken up. And you can see that the left-hand side of this page, those four bars are equal to me, around 13%. And you can see there are many combinations there within those bars. If you do get a D Congress and a D president, you're only up 9.3%, right? I reiterate, all these are positive. Markets can do well under any regime in Washington. And the good news or bad news is most of the regimes don't last very long, right? The electorate continues to change Washington to try to get it to work together better than it certainly has been in the recent past. So again, and please take this with a grain of salt. A lot of this is what the president inherits from the past president. There's war and peace in here. There's high inflation. There's low inflation, right? There's a lot of backgrounds in the last 100 years, including World War II, Vietnam War, Korean War, right? All these other things. So, but it just does show you that regardless of backdrop, they're all positive. And for the most part, you get around an average, right? On the left-hand side of 13, even to the right-hand side, it's still upwards in the high single-digit returns. So wanting to run to cash because of a presidential outcome just doesn't make any sense historically. Next page, please. This is a map and model. The charts that I've shown you up to this point are really up to the minute. This chart is anything but. It was drawn 18 years ago by me in my office in San Francisco, California. It is a map of history. What I wanted to do was to show how the economy and the stock market dance with one another. And I wanted to then map history. And I've taken 25 years of my life to figure out this page. Because while it was rattling around in my head 18 years ago, it was half art and half science back then. I took the next 6 years, 02 through 08, and removed all art from this page. So I'm one of those rare characters using both economics and markets, and combining those two together have mapped almost daily history. And then what I do is I compare the current market and the way it is behaving economically and market behavior. And I go back and look historically about where does that tie? And I've done it all quantitatively. So there is no human emotion. There's no guessing. It is a map of history. There's a sequencing to a history. And as we have walked through even COVID-19 and recovered from it, markets have recovered from it. This market, to shorthand the answer, is behaving like a mid-cyclical market. We are at 9 o'clock, for example, with this methodology. I've mapped every 6 o'clock going back 50 years. Every 6 o'clock, those are market lows. I've mapped every 12 o'clock, those are market or economic highs. I've mapped every 7, every 9, and every 10. These are bull markets as they change their definition of beauty as they age. I showed you a chart about the market that is broadening. This is typical of a market as it ages. And because it has broadened, it actually moves the arrow because it's behaving like a mid-cycle market does, both economically and from a market perspective. The right-hand side of the page is economic contraction. We are certainly not over there. We did have a black swan event. I look at COVID-19 as a black swan, but we've recovered from that. We spend most of our time on the left-hand side of this page. We continue to be there today. 9 o'clocks last an average of 13 months historically, and markets go up an average of 10 to 15% as measured by the S&P 500. This 9 o'clock happened on July 31st, 2020. We knew that, by the way, on July 31st of 2020. This is a real-time instrument. So we're 2 months and 20 days into this 9 o'clock. Markets are up just like they historically are. They get volatile, but they're amazingly resilient here. And that's what we tend to see. If markets do recoil from here, buying dips at 9 o'clocks historically would have made you rich. And I think this 9 o'clock will prove to be no. Let's go to the next page and I'll show you the output of our committee and how we're currently structured. Our output for our committee to all of our portfolio managers is that we are neutral equities. The 9 o'clock market would tend to have us overweight equities, right? It's a bullish backdrop typically. But the wheel does not know about COVID-19. It knows about the economics of COVID-19. It knows how markets are behaving. But COVID-19 to me is still a variable that cannot be mapped or modeled. And so for that reason, we've pulled in our horns a bit and moved to neutrality. We have a slight home field bias in the US over international. We're underweight fixed income. The low interest rates don't offer as much protection as they would if rates were higher. And for our clients that own bonds, of course, we'd like them to have yield, either corporate bonds, municipal bonds, or even high yield. And for those clients that allow diversifiers in their portfolio, we especially like absolute return strategies because they buffer portfolio from what I think is volatility in the next couple months without having the interest rate sensitivity of fixed income. So I continue to be constructive on markets as I look out intermediate and longer term, although I do see some choppiness in the month ahead or in the months ahead. But again, 9 o'clock really helps me that I would be buying that dip and buying weakness in the near term because I think we're set up decently well for a better economy and a better stock market than most people are thinking as we sit here today in late October. Again, I'm not bullish or bearish innately. I'm trying to help people navigate markets and economic cycles. And that's sort of as I look at all the data that I do on a daily basis, including mapping it very accurately through history without any emotion. Continue to like what I see. We still have to battle the virus and work on vaccines and better therapeutics and those types of things. But we built bridges, both fiscal and monetary bridges, that I think will help us get to the other side of this. And at the other side, maybe better economic outcome than a lot of people are discounting. With that, why don't I stop and turn it over to my co-speaker, Brennan, and I'll let him take you through some REIT work, and then we'll do some Q&A. So I'll turn it over to you.
Fantastic. Thanks, Jeff. And again, very insightful. I am particularly interested in your slide about the savings rate spiking to 35% earlier this year. I don't think my family is aware of that, so I'm going to print that slide out and share it with them. See if they can buy into it. So the next 15 or 20 minutes or so will be much kind of less global and more specifically focused on a particular sector. And that particular sector is the clinical outpatient healthcare sector. We'll show a little bit of information about healthcare real estate. Generally speaking, our specific focus within that subsector and why we find it to be an attractive asset class for what we think will be the next 20 or 30 years or so at least. And then spend the last few minutes specifically talking about Flagship Healthcare Trust. So this starting slide here is just an example of a ambulatory surgery center, an outpatient surgery center that we constructed in North Carolina. So thank you. For the next slide, overview of some current market trends for private healthcare REITs, and thought it would be useful for starters to talk about what is a REIT. And a number of you certainly know what a real estate investment trust is, but for those of you who do not or are not as familiar, a REIT is simply a corporate structure that was put into place by the U.S. Congress in the early 1960s to make it easier for individual investors to invest in commercial real estate. And you can liken it to the inception of the mutual fund industry, making it easier for individual investors to buy stocks and bonds in a diversified portfolio without 50 or 60 years ago having to buy 100 shares of IBM and 100 shares of GE and 100 shares of AT&T. They could instead access that diversification through a mutual fund. And so that's what a real estate investment trust, why it came into play. REITs have certain requirements and certain restrictions due to ownership, due to the diversification of their owners and their investors, requirements to distribute 90% of their taxable income. And in exchange for meeting all those guidelines, REITs avoid the double taxation that exists with other C corporations. So three main types of REITs. There are public traded REITs. So when you look on the New York Stock Exchange and you type in a ticker symbol for some of the publicly traded REITs like Physicians Realty Trust or Welltower or Ventas or Healthcare Trust, those are all REITs, the same corporate structure that we have, but listed on a public exchange. You've got public non-traded REITs, which existed for have existed for a number of years. They had some dispersions and questions about transparency and fees that has been cleaned up a lot, but another public model of a REIT. And then you have private REITs, which is how Flagship Healthcare Trust is structured. And you have sector-specific or diversified REITs. Flagship is focused sector-specific on the clinical outpatient sector. So current market trends right now, when COVID first hit, the public markets took a major dive, and healthcare real estate was no exception. A big part of that was some of the more diversified public REITs that had exposure to senior housing. And so we know where the early onset of COVID began in this country and how rapidly it spread, and some of the death rates that are far higher in senior housing facilities than in the general population. That's continued to weigh more heavily on the shares of some of the REITs that are focused on that sector. Let's go to the next slide, Dan. Why do we think the outpatient clinical healthcare industry is attractive? This slide, I think, demonstrates to a large degree why that's happening. And this trend has been going on for more than 15 years, but this just shows a chart showing the surgery center growth and how it has moved from inpatient surgery, so where an overnight stay is attributed to an inpatient, versus an outpatient surgery center. And so as of 2020, literally 2/3 of surgeries are occurring in an outpatient setting, where a patient can walk into or be wheeled into a surgery center. The surgery can occur and they are walked or wheeled out same day, but not an overnight stay component. This is a trend that is not slowing down. Hospitals are pursuing this, and patients are pursuing this. So as the delivery of care continues to shift off campus, I refer to the 3 C's as driving that. That's care, convenience, and cost. So care, actual outcomes, surgical outcomes, can be higher in an off-campus setting with lower rates of infection. The convenience is certainly an improvement in outpatient surgery centers, where instead of having to drive to the main hospital campus, park on the 6th level of a deck and find your way through myriad elevators and hallways, you can drive to a conveniently located surgery center that's in your neighborhood or near your neighborhood, have surface parking, and it's a lot more convenient. And the cost of delivering surgeries in an off-campus setting is both better for patients. It's more cost-effective, and hospitals can move those surgeries off of their higher-priced real estate in the form of hospital campuses. Surgeries will not be slowing down. The statistic that 10,000 Americans turn 65 every day in this country is not slowing down. So that will continue in the years and decades ahead. Let's go to the next slide. Healthcare is now, by at least some definitions, the largest employer in the U.S. with over 13% of all jobs. And the growth is continuing at a rate that is higher than just about everything other than higher education spending. And it will continue to grow and add another 2 million jobs over the next 7 or 8 years. When you measure GDP and what percentage of that is going to healthcare, by some measures it is plus or minus 20%, but that 18 to 20% excludes a lot of government and military spending on healthcare. So that number is probably even in excess of that traditionally stated GDP percentage. The aging population, as you might expect, demands more and utilizes healthcare more than the average American. Statistics vary, but some say that most Americans will go to the doctor's office on average about 4 times a year. When you approach age 65, age 75, and age 85, those numbers drastically increase to 8 or more, 10 or more, or 12 or more visits per year. And so one of the things we'll talk about is the geography that we focus on. But as seniors continue moving to the Southeast and Southern Mid-Atlantic, the demand for healthcare in this part of the world also continues to grow. All right, Dan, let's go to the next slide. All right. One thing that we have been questioned on a fair amount, receive a lot of questions on, is what's happened to the healthcare real estate business in the age of COVID. And back in early March, in mid-March, when the coronavirus was first becoming, a well-recognized pandemic, healthcare tenants were much like every other real estate tenant. There was an initial knee-jerk reaction of panic and uncertainty. We received calls at Flagship from about a third of our tenants who expressed concern and, you're my landlord. What are you going to do to help get through this crisis? That very rapidly subsided, some with government programs like the PPP loans or the CARES Act, some when businesses that had to be shut down, like dental professionals, general dentists, dermatologists, groups like that closed their doors for 30 or 60 days, realized that people weren't going to go without health care. They adapted in how they were delivering care, whether it was having patients wait instead of in their lobby, but waiting in their car for appointments. The use of personal protective gear that really hadn't been quite an area of focus previously. And we found that out of 190 tenants, unique tenants in our portfolio, we had less than 10 where we had to accommodate some form of rent deferral for a 2 or 3 month period. Now, as you look kind of 6, 7, 8 months on from the start of the pandemic, all of our tenants are now back open and seeing patients. Our surgery center patients in general are seeing 85 to 90% of pre-COVID patient levels. And some of our specialists, dentists in particular, have even achieved north of 100% of pre-COVID levels. And when you think about it, if you've got a cavity and you were putting off going to the dentist because of COVID-19, your tooth's not getting any better. Same is true if you need cataract surgery or a knee replacement or a shoulder scope. Those ailments are not going to fix themselves. And so it has really become a resilient, it has revealed itself as a resilient industry. We did see some increase in hospital systems and physician groups who looked to explore sale and leasebacks of their owned real estate to generate additional liquidity and provide flexibility. As additional healthcare guidelines for dealing with COVID became more clear and more consistent, capital from hospital systems was being directed in other areas besides brick and mortar. And so healthcare systems, even with telemedicine, couldn't outsource the patient treatment. They still needed bricks and mortar, but they were able to do that through leased facilities. Let's go on to the next slide. This is just a relatively short-term, last 3 years or so overview of cap rates for medical office buildings, both those located on hospital campuses and those off hospital campuses, which show that the cap rates, or what an all-cash buyer would demand for a return on their capital, have remained relatively steady over the last 3 years, at about 6.5% return for off-campus buildings, and about 5.8% returns for on-campus buildings. So the disruption and that COVID caused really didn't change values in the healthcare sector quite as much, if any, unlike what we saw with retail properties, with general office properties. All right, let's move on to the next slide. All right, a couple more trends that we'll touch on just briefly. First one talks about increasing and stable tenant demand. So this is change in employment for physicians and surgeries and surgeons over the next, the 10-year period from 2018 to 2028. Healthcare is one of the fastest growing employment sectors. The middle chart shows a distribution by date of construction of medical office buildings. And you've got in this country 82% of medical office buildings that are at least 10 years old, 55% that are 20 or older, 20 years old or older, and over a third of medical office buildings in this country are 30 years old or older. So there will be some facilities that are older can be improved and renovated and can still be usable. Others are functionally obsolete and will need to be replaced. So there's going to be a continued need to replace the stock of medical office buildings. And the chart on the right shows the age growth of older Americans that are continuing to age, the graying of America, or the silver tsunami. And so we have 55 million Americans that are 65 and older today. That will increase to 70 million by 2030 and to north of 80 million by 2040. Let's move to the next slide. Our strategic focus at Flagship is on the southeastern and southern mid-Atlantic. We've got a lot of drivers, including the aging population, not just in place, but relocation of seniors moving from other parts of the country to the Southeast and Southern Mid-Atlantic for a number of reasons. Quality of life, cost of living, improved weather, and importantly, and not as a secondary consideration, many folks are moving from the Northeast and the Midwest to the Southeast to be closer to children and grandchildren. All of that because of the preponderance of usage of medical office buildings from that senior cohort will provide increased demand for medical office buildings and imaging facilities and ambulatory surgery centers that you see on the right-hand side. All right, next slide. That's a little bit a quick, but a little overview of the healthcare real estate sector in general. What makes Flagship different? What is than some of our competitors? Really, there are three main attributes that I like to focus on. One is that we're private, two is that we're focused, and three is that we're vertically integrated. Let's hop to the next slide, Dan, and I'll keep talking about those three traits. This slide, the healthcare continuum that we like to refer to as our Candyland or our chutes and ladders slide, shows the continuum of care from starting in your home all the way down to hospice and end-of-life care. And there in the middle, in the acute care stage, is the hospital campus. But unlike Monopoly or landing on free parking, that square is the go directly back to the start square. Hospitals don't want you there. Patients don't want to be there for all the reasons I talked about earlier in terms of cost of care, convenience, outcomes, and levels of care. So Flagship's focus is on the left-hand side in the outpatient pre-acute setting. So we buy, build, lease, manage properties where patients receive treatment from a provider where they enter into the building and exit the building on the same day. And so importantly, when we describe what we invest into, sometimes it's easier to understand what we don't invest into, which is on the right-hand side: skilled nursing, inpatient rehab, assisted living facilities. We share the same demographics in terms of who our customer base is, but a very different level of risk in some of the overnight stay facilities and that's not an area that we focus on. Why Flagship? Again, next slide, Dan, please. As a private vehicle, we show a low correlation to the public markets. We get asked all the time, well, why shouldn't I just buy a stock that's a publicly traded healthcare real estate company? And we have nothing bad to say about our publicly listed brethren, groups like Physicians Realty Trust, Healthcare Trust of America, Healthcare Realty Trust, are all medical office building focused firms that do a great job. And we're proud actually to call those groups clients as we lease and manage some of the properties, their properties for them. But when you look at a chart that compares the public REIT performance with the Dow Jones, S&P 500 over 5 and 10 year and longer periods, you'll see correlations that are north of 90% and even approach 98%. So if the market is up 2% today, there's a good chance that those public REIT stocks will also be up somewhere near 2%. And if the market is down 2%, there is a great chance that those REIT stocks will also be down 2%. As a private REIT, we do not trade according to a ticker symbol or the click of a mouse. We receive valuations of our real estate based on independent valuations every quarter that look at the value of our assets, our liabilities, and market values of real estate and trade at our net asset value. So we believe we have an advantage that we're not going to trade at a premium or a discount, but rather based on what the net intrinsic value of our real estate is. We're also a focused REIT, so we're focused geographically. We're focused as it relates to property types, so clinical outpatient as opposed to the entire healthcare sector. And we're focused on investing into core plus, value add, and ground up development opportunities in that medical office and ambulatory surgery center sector. Lastly, we are a vertically integrated firm, and that is perhaps the most important differentiator for us in that we have a staff of property managers, property engineers, maintenance technicians, leasing and brokerage, asset management, ground up development, 80 plus professionals that have knowledge and data and expertise in this field, and importantly, generate relationships with the healthcare providers. Our REIT targets annual returns of 10 to 14%, which is roughly half in the form of income and half in the form of capital appreciation. And we really seek to be an allocation for accredited investors who are seeking exposure to healthcare real estate that's not correlated to the public equity market, that's an alternative to the fixed income market, that has components of private ownership of real estate and inflation hedging with components of all of those aspects. So next slide or final slide shows just some highlights of our REIT, but I think my time is up at 10 minutes to the hour. So Dan, I'll turn it back to you or Jeff or Scott.
Thanks, Brandon. Jeff, I know you have got to leave here in a short minute, but one question that I know some of our guests had asked today, if you could just opine on it for about a minute. You hear about the upcoming election and what sectors are going to benefit from which administration, the difference between a Biden portfolio and a Trump portfolio. Could you just share, as we get closer to November 3rd, what areas we think benefit from either administration? And with that, I'll let you go after that.
Yeah, so let me talk to you about that. A lot of strategists have put together portfolios which, in theory, would do better under a Trump administration versus a Biden administration. Biden might be green, right, environmentally friendly, electric, right, all those types of things. And Trump might be more of defense spending, right, the lower regulation, those types of things. Punchline here is that it's interesting. Up to this election, the Trump portfolio has not performed as well as the Biden portfolio. But another punchline is that after Trump was elected president, and during Trump's presidency, a Clinton portfolio has done much better than a Trump portfolio has done going into 2016. So in other words, it's very hard to do that type of work and think, if I know who's president, I'll know what stocks to buy. Technology stocks have done well under Trump, and it may not, and defense have not done as well. So it's very interesting. Please take that all with a very high grain of salt. It's much more important to see where you are in economic cycles. As I mentioned before, we've pulled 2020, from 2023. Take a look at those trends that, regardless of who's president, are happening. I don't mean to dodge the question. I just want to put that question in perspective, because it can lead you in areas where you will maybe think that you're right, but turn out that you've missed significant opportunities because of these overarching themes that play out regardless of who's in power. So I hope I answered the question. Biden's portfolios have beaten Trump's, very similar to the polling data and the betting lines. So that's what we're seeing. Whether or not that continues or those stocks are already priced in, right? Those are the things you have to wrestle with. So be cognizant of that. But those things up to now are telling us the same stories that the polls and betting lines have up to this point.
Got it. Thank you, Jeff. I know you have another interview to go on, so we appreciate your time this afternoon, and
Thank you.
Yeah.
It was a pleasure. Talking to all of you. Stay healthy, stay safe, and I hope next time we can do this in person. Thanks for inviting me on today.
Yeah, thanks, Jeff.
Yes, bye-bye now.
Brandon, we still have time for a few questions.
Absolutely.
In regards to, I know some of the audience sent us some questions just in regards to what you're seeing in your business. As healthcare continues to become a larger part of the economy, what does that mean for Flagship Healthcare and REITs similar to yours? How do you see that affecting your business moving forward?
We think it's a net positive for our business for some of the reasons from one of the earlier slides on impacts of COVID. As demands on health systems continue to grow and efficiencies are demanded of those healthcare systems, whether they're for-profit or not-for-profit, for-profit or not-for-profit systems, they're going to look for ways to operate more efficiently and gain economies of scale. And one way to do that is to outsource their real estate. And so we're honored to be able to work with a number of health systems and physician groups who say, is this really the best use of my capital, having my capital tied up in buildings, when instead I can be using that capital to acquire another practice, acquire equipment, hire another surgeon or provider, and so that's going to provide additional opportunities, we think, in the years ahead.
Got it. And I think we have one more question that's related to you. With the Supreme Court being a big topic of conversation right now, what would the repeal of Obamacare do to your business?
Great question, and one that we get fairly frequently. That is obviously something that's been talked about a fair amount on the campaign trail of whether Obamacare will be repealed or affirmed. In all likelihood, we believe that there may be aspects, depending on what the next court looks like, there may be aspects of Obamacare that are removed or labeled as unconstitutional. There may be aspects of Obamacare that Congress will dismantle, but estimates have that Obamacare is providing some level of insurance for 30 to 40 million Americans that otherwise wouldn't have it. And I think politically, it'd be very difficult to go backwards with a wholesale repeal that removed health insurance coverage from that large a chunk of Americans. But at the end of the day, the surgeries, the primary care functions, the specialists that are using our facilities will continue to deliver care to an America that demands better and better healthcare. As a country, we are living longer and longer, but not necessarily healthier. And so as we age, we demand and require more healthcare. So whether Obamacare is repealed or affirmed in its entirety or partially, we don't think that's going to have a material impact on the demand for the medical office sector.
Thank
Scott and
you.
Brandon, I think we had a question from one of our attendees. David, I'm going to unmute your line and you can go ahead and ask your question. Go ahead, David.
For the ground up development of either surgery centers or MOBs, what is your sort of prototypical, what is in your sweet spot?
Sure, great question. And is that with regard to the types of facilities or the locations or sizes or what aspect?
Primarily asking about sizes. For example, if you have a suburban MOB, would it need to be a minimum of, say, I don't know, 25,000 square feet to a max of X?
Good question. No, one of the benefits of that I think of being Flagship size, we have about $500 million in real estate assets in our portfolio, is that we're our mission is to provide extraordinary stewardship and outcomes for those that we gratefully serve in healthcare real estate. So it's not just our investors, although it's their capital that's at risk. But we're, for instance, delighted to be working on two ground-up medical office building developments for UNC Health in the Greater Triangle area. Each of those buildings is approximately 15 to 20,000 square feet. So while the average building in our portfolio is about 35,000 square feet, we have surgery centers in the portfolio that are smaller than 10,000 square feet. And we've got buildings that are over 100,000 square feet. So it is really more geographic and relationship driven than it is size.
Thank you for that. Just one other quick question. Have you ever done conversions of like large boxes?
Yeah, there is a lot of talk about in particular retail to medical conversion, which can and many times make sense because you've got generally with call it an old mall or an underutilized mall, you have an abundance of parking. You typically have good ingress and egress. And because of those big boxes that in many cases are dark, the value can be relatively inexpensive to purchase the improvements. The challenge is that those buildings generally need significant retrofitting in terms of plumbing, in terms of windows, in terms of interior corridors. So we have done some retrofitting or redevelopment of existing non-medical facilities, converting them to medical, but it's not always as easy as it may seem on the surface. But there will clearly be an increase in that with what a number of malls are going through across this country right now. That is a logical adaptive reuse for many of those facilities.
Thank you very much.
Thank you.
Brandon, we are up on our hour. Just wanted to say thank you for everyone for joining today. For those of you that had a question for Jeff, sorry he had to hop off early. Feel free to send those to Dan, and we'll make sure to get those answered. Brandon, I just want to say thank you to you and Flagship for your partnership on this event, and look forward to doing more of these in the future.
Thank you so much for including us, and thanks everybody for participating, and look forward to continuing the dialogue. Please reach out to us if we can help in any way.